So we all know that the most important aspect of trading is risk management. You have to learn to manage your risk if you're going to be a successful trader. And if you're familiar with trading lingo, if you hang out in any kind of trading community, you will often hear the phrase, never pick up pennies in front of a steamroller. That's always the warning, especially experienced traders will often tell new traders, never pick up pennies in front of a steamroller. But what does that mean? Well, picking up pennies in front of a steamroller, kind of like the analogy suggests, is when you put on a trade that your max reward is very small compared to the risk you're taking, right? You're literally picking up pennies in front of a steamroller. So let me give you some examples of this picking up pennies in front of a steamroller. Let's imagine that I want to sell a short put in NVIDIA. Typically, I like going about 45 to 60 days to expiration. So I'll go to the 48-day cycle here. And typically for deltas, I like to choose a delta of between 16 and 30 deltas. So let's imagine I sell this 25 delta put in NVIDIA. I'll receive a 465 credit. That's a very juicy credit on a buying power reduction of $3,700. So that's pretty good risk reward in my opinion. But some people won't like this because a 25 delta put, you're going to lose on that 25% of the time, right? You'll win 75% of the time, you'll lose 25% of the time. So a lot of people, they want to try to get their win rate as close to 100% as they can. So they'll move that down instead of 25 deltas. Maybe we'll go all the way down to 10 deltas. Now you're only receiving a $1.55 credit on a buying power reduction of only $2,200. So the buying power is lower too the further you get out. But still, you know, you're on a percentage basis, the risk reward is not as good as had I done that 25 delta put. But a lot of people still 10 deltas is not enough. I still want to get as close to 100% chance of winning as possible. So they might do something really dumb, like sell this 3 delta put, right? I sell this 3 delta put. I only receive 43 cents credit on a buying power reduction of $1,700. And here's the thing, none of these are ever going to be 100% winners because you never know how markets are going to act. You never know what the future holds. Could NVIDIA crash and lose 30, 40, 50% of its value tomorrow? Yes, it's possible. Trust me, I have had naked short puts and naked short calls plenty of times go against me in big ways. I've seen stocks lose half their value or more in a single day. Here recently, I saw a stock nearly double its share price in a single day, and I had a naked short call on it. And when stocks make those kinds of moves, there is not a option on this options chain you could sell that would be safe from that kind of move. So there's no getting around that. You are in a lot of trouble no matter which option you sell in that case. But here's the thing. If I sell this 25 delta put, at least I receive $465 for selling that put. Yes, I'm still screwed if NVIDIA, drops by 50% tomorrow, but at least I was, getting some reward. At least I was getting paid to take that risk. Were you getting paid to take that risk if you sold a 3 delta put and only collecting $43? No, absolutely not. One of the most insane things I see people do is, people will see this 25 delta put, where I could collect about 465 credit, but they don't only have a 75% win rate. So they still want a very high win rate, but they still want to collect 465 credit. So they'll go down to that 3 delta call where they were receiving 43 cents credit, but you know what? They now have a 97% chance of winning. That's a really good chance of winning, but not enough credit. I still want that 465 credit that I would receive from the 25 delta put. So let me just sell multiple contracts. Maybe I sell, I don't know, we'll bump this up to 10 contracts. Now I'll receive $430 credit, right? But look at my buying power because I'm at 10 contracts now. My buying power reduction is $17,000. And again, you never know when a stock is going to crash hard to the downside or to the upside. And in this case, if NVIDIA lost, say, 30% or 40% of its value tomorrow, again, it didn't matter which put I sold, I was going to be in a lot of trouble. And in this case, what I did was extremely stupid because I have 10 contracts here, right? 10 contracts means that if I got assigned at this 85 strike, I would have to buy 1,000 shares of NVIDIA. Where if I sold the 25 Delta put, one contract, for the same amount of money on a much less buying power reduction, even if I got that crash in NVIDIA, it went hard against me, now I'm being assigned only 100 shares. So again, it just makes sense. Don't pick up those pennies in front of a steamroller. Don't get way out here in these trashy short puts, or on the other end of the trade, trashy short calls. Do not do that. It is simply not worth it. Also, never sell multiple contracts when simply upping the delta makes more sense. For example, if I had a choice between selling this 30 delta call or selling two 14 delta calls, 15 delta calls to get the same, directional exposure, which one would I choose? Well, I always want as few contracts on a short options trade as possible, because again, if you end up in a situation where you're facing assignment, one contract is a hell of a lot different than two contracts. And don't even get me started for those of you, that are way out here and doing things like 5 contracts, 10 contracts at a time, when really one contract would get the job done. And it's not just naked options that I see people doing this kind of stuff. Sometimes people do this with vertical spreads as well. Let me go to a different ticker symbol. I'm going to go to SPY. I'll go to the 48-day cycle in SPY. So let me do a put credit spread. With credit spreads, whether it be a put credit spread or a call credit spread or an iron condor, typically I like risking 2 to make 1. Sometimes I'll go as far out as to risk 3 to make 1. But for risk reward, I don't want to get much lower than that. So here in SPY, what I'd probably do is let's try to sell this put here, the 34 Delta put, the 552 strike here. Then I'll go $5 wide, so that would be 547 that I would have to buy here, the 547 put. And this $5 wide put credit spread, you can see I'm going to receive $1 credit, and my max loss is $3.96. So I'm risking 4 to make 1 in this case. So I really didn't want to get too much further out than risking 3 to make 1. So let me move these in a little bit. Maybe move the strikes in to the 555 short put and the 550 long put. Now I get a credit of 125 and my max loss is 375. Now that is exactly risking 3 to make 1. And for me, I'm comfortable with that, because I see people doing these insane vertical spread strategies where, they're going to do a put credit spread, for example, in SPY. People love selling put credit spreads in SPY. I see a lot of YouTubers, especially some of the fake trading gurus on YouTube, doing things like selling a 10 Delta put, for example, a put credit spread. So we'll sell the 10 Delta put and we'll buy, in this case, I'll do $5 wide. I'll buy the 519 put. Now look at this credit. You're receiving 24 cents credit on a max possible loss of 476. But again, of course, the fake trading gurus on YouTube, they really don't focus on that 24-cent credit, that insanely low credit. They're like, hey, well, you have a 93% chance of winning. And if you really want more credit, instead of just selling one contract for 24 cents, why don't you sell about 10 contracts? Yes, let's sell 10 contracts. That way I get my credit up to receiving $240 credit, but I'm risking $47.60. I'm risking nearly $5,000 to collect this $200, and this doesn't make sense. Again, picking up pennies in front of a steamroller, because the S&P 500, which SPY, by the way, is the S&P 500 ETF, the market does crash on occasion. Sometimes it crashes hard, and it would not be unusual to wake up tomorrow and have SPY down 20, 30, 40 points, right? And this insanely cheap put credit spread, I'm going to get completely killed on, right? I'm just going to be massacred on this trade if it goes against me. So don't get too cute with your trading. Some of you guys, you're trying to be a little too smart for your own good. You're getting way out there as far as you're selling these way out of the money short puts and short calls, or you're selling these way out of the money credit spreads and iron condors because you want as close to 100% win rate as you possibly can. But you don't realize you're not actually reducing your risk by selling those cheap, trashy puts and calls. What you're doing is you're actually taking on more risk. risk, because you can never take all the risk off the table. You never know what's going to happen in any market tomorrow. You could see a 5 standard deviation move to the upside or to the downside in pretty much any product you're trading. You know, it could happen tomorrow, and there's no way that you could prepare for it. It's unforeseen circumstances. We call these outlier risk, and you know, you can't get around that. But here's the thing: if you're one of these people that all you're ever doing is picking up those pennies in front of that steamroller, you're going to get squashed. Just some food for thought. Peace, guys.